Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk about kind of the way that I just view things, my outlook, my viewpoint, my paradigm, however you want to call it. And I'm playing the big picture view. So let's go back to strategy. Let's knock this out of what my viewpoint is, why I hold the viewpoint, and some arguments maybe for or against it. So my viewpoint, when looking at it, my strategy playing this bull market is to buy the heck out of the bottom, accumulate along the way as I make money, and buy pullbacks based off of support levels and where I think the charts look good. Doesn't mean I nail every bottom. I know that. Neither will anyone else. So I put into place strategies where I call it sprinkling. Sprinkling is cost averaging in. If I see a point that looks pretty good, I buy some. Some buys are incredibly well timed. Other buys are not that well timed. It's just the way the market is. It's the way of playing the game. So I've got some data here behind us too that we can go over, and we're going to stick with strategy. Now, I know a lot of people are very worried about the markets, recession, higher interest rates. I think what you want to ask the questions to yourself is, well, why are they raising interest rates? And are they the ones actually increasing the interest rates, or is the markets forcing it upon them? I think that it's a combination of both of those things. I think the market's forcing it upon them, and I think that they have some control, at least right now, of where rates are going. They are talking a big game, and they need everyone in the markets to think that they have this under control. My question is, how do you know they have it under control? What makes you think that they have this inflation under control? They're going to have to talk a big game to make sure that you and me and everyone else thinks they are in control. They need you to think that we're going to crash. They need you to think that we're going to have pain and that they're going to talk big like they can push all this stuff around. Now, my question is, which is kind of weird. I'll make some statements that seem obvious but stupid to me. So during the medical event, they were so worried about a deflationary crash that they printed a ton of money, 40% of the increase of the total money supply. They threw this into the system, and we opened back up the economy, and inflation, shortages, supply chain shortages, inflation all came about. The very thing that they wanted to avoid was a deflation and a crash and a recession. So they printed all this money. We got the inflation that they wanted. They even said, hey, look, inflation can run hot here. We're going to let it run hot. So then, as it ran hotter and hotter, they are going to try to quote, kill the demand by raising interest rates and causing a recession. Well, isn't that the very first thing that you were trying to avoid? Was the recession? Why all of a sudden are they panicking, saying that they have to raise rates all the way to the moon and get everybody to panic around them about a potential recession and that pain will be felt? Well, if interest rates moving up stopped inflation, how come it didn't do that in the 1970s? How come the demographic had to run out in the early 80s for that inflation to subside? How come oil had to come online from other places around the world? I think that oil and the increase in gross domestic product and the demographic coming back down in terms of we'll call it the rush into real estate, basically slowed that inflation down. It wasn't Paul Volcker raising rates to the moon. It definitely slowed things down, yes, but it didn't stop it. That wasn't the root cause. The root cause of that inflationary ending was not high interest rates. They didn't kill inflation because of the high interest rates. If that was the case, they could just dial this up and down whenever they want. But why did it have to get to such a level? What makes you think they have this under control, and what if they don't? So my question then is, if they don't have this under control, how would you want to be positioned? Well, you'd want to be positioned, if they don't have the inflation under control, you would look basically like Germany and England and all these other countries that we're seeing we have a seat to a show where currencies and bond markets are basically collapsing in front of our eyes. What makes you think that that's not going to come to the United States? What makes you think we're insulated from all of this? Good questions, right? So you're looking at these currencies and these bond markets falling at speeds that we've never seen before. Let's take a look at it real quick. I've got some stuff up here. So what I'm talking about is the UK 10-year gilt. And this is their bond market. And they had to step in here and flood it. They had to buy all these bonds to basically, of course, I'm talking with me in here. They had to basically buy all these bonds to stop this collapsing move. This here is a problem. They're in there buying the living poop out of this. They are buying and buying and buying and creating money and creating inflation, which got them into this in the first place. Money printing and an energy crisis combined. Checkmate, Putin wins. Well, this is going to happen in more countries. And as the shortages of energy take hold of highly indebted countries, and as their debts increase and their GDP decreases, you're going to see currencies start to crack and break. So this is what the bond market looked like. We went from $120 and they started buying at 92. And that was the big move lower. We were originally up at 140. 140 all the way down to 90 in a little over a year. A year and a half, 2 years. That is an absolute decimation when it's your bonds. Pension funds, government, entities that own this garbage are having problems. So my question to you is, if we're seeing this and we're seeing the producer price index, we're seeing the consumer price index going vertical in Germany, electricity prices, and all of these other European countries, what makes you think they have this under control? I don't think they do. And I think it's going to spread. We've got Yellen, who doesn't even know what inflation is. I don't know what the heck she's doing, but she's saying that oil is going to go to the moon this winter. I agree. I definitely agree. They're trying to manipulate all this. So let me ask you another question. If you knew nothing about the markets and I were to describe this situation like I'm going to describe to you, you let me know what you think. So I'm going to say, all right, looking at the last bull market in oil, we were coming up in inventories. The price was continuing higher in oil as our inventories were going up. We had a slight pullback in our inventories. We pulled back 10, 15% in our inventories. And oil shot up to $140 a barrel at the end of that real estate cycle in 2008. Now, as we built our inventories up and up and up and up, with the strategic petroleum reserves being built up, with our commercial inventories building, and now we went from a level that was much higher than we are today, maybe 30 or 40% higher. And we are coming back down, and we're at the same level as we were inventory-wise when oil was at $140 back in 2008. If we want to do a quick look, I'll pull this up for you guys. I had this up on my Twitter, and I'll show you what those inventories are to show you exactly what I'm talking about. So here's the inventory levels of, let me scroll down here and get it for you, because it's important to understand this, guys. Like, I'm hearing all these people, they're all afraid they should go to cash. I just want to bring up some valid points here. So here is okay, I got to go back a little bit more here. 1 second. I've got one down here. Here it is. This is the U.S. Petroleum, of course. Here it is. This is U.S. Petroleum crude oil product and SPR inventories. When we were down here, this was the drawdown from 1.75 to 1.65. That's 100,000 barrels over, this amount, less than 10%. Less than 10% of a pullback in our oil inventories, and we go to 140 in 08. We are dropping off a cliff here. We've broken the uptrend line, and we're back roughly to the same spot that we were in 2008, and we've got a higher production in the world, which means our coverage of inventories in relationship to the supply is much less than it was in 2008. So the question you should be asking yourself is this: how did we get to 140 during this period when we have way less inventory in relationship to production that we have today? And during this time frame, it was a slow little move into a bottom. This one, we don't know if we've bottomed, and we're dropping a rock off a cliff here. We have not bottomed here. We have just been eating through our inventories at the fastest pace, I think, of history. And we've also made the largest move downward in our inventories in terms of from peak to where we are today. So my question is this: are interest rates slowing this move down? No, it's not slowing that move down. We've been hiking rates for a little while now, and it hasn't slowed that move down. So what makes you think they have this under control? The energy markets are breaking over in Europe, those countries. They're breaking bond markets, they're breaking currencies, they're breaking a whole bunch of stuff. And I think what they're doing is they're going in defense mode, trying to save our currency. That's what I think they're doing. But here's the thing: it's out of their control, guys. I don't think they're not controlling this anymore. And you see OPEC, they're trying to do stuff for elections. They're trying to send certain market signals saying everything's okay. We'll lower the gas prices, XYZ. OPEC saying no, 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 no. So my question is, if you've got currencies failing around you in other countries, and you think there's a possibility it could come here, well, how do you prepare yourself for that, right? How do you position for that? Are you going to go position in a bunch of dollars and cash if other cash currencies are eating it and bond markets are collapsing? I'm not going to go in the bond market. Does this bond market, does this look like it wants to go down in yields? This is breaking to the upside here. This is a new shift in increasing interest rates. Now, could this pull back? It could. Or this could break. They might be in there trying to buy this and control this move, slow this move down. They might fail. We might see a launch higher here. It's possible. Now, do you want to be positioned in bonds if everyone's basically selling bonds? No, I don't want to be in bonds. I don't want to be in dollars either. These things are going to get torched. So my question is, let's say we get a crash. We have a recession. And I have to live through a big pullback, and I get to buy more of my favorite precious metals and companies and energy at cheaper prices. Let's just say that happens. So my life carries on completely normal. Nothing happens to me. I get a 20%, 30%, 40% haircut on what I own, which I bought at the bottom of 2020 and 2021 and all these other times that I accumulated, and I get to buy more shares cheaper during this gigantic paradigm shift that's happening right before our eyes. And if someone piles into dollars and they're wrong, well, what's the ramifications of that? What is the ramifications of loading up on bonds if you owned UK gilts? Well, you just got smoked. And you know what? They had to come in there to save it. And I think they're going to actually buy less of them in a couple of days or something like that. We'll see where they go. Now, if your bond market's collapsing, what do you think about the currency market? Do you think that's going to be strong? No. And what is the response that people are having in those countries? What are the response of people in Turkey? They're running to gold. They're running to silver. They're running to precious metals. They may be running to crypto. I don't know. I don't really follow that market, but they're running to other things. They're running to commodities and other hard assets. What do you think the UK is going to do? What do you think Germany is going to do? They're all going to do the same thing. They're all going to run to hard assets. They're all going to run to these things. What makes you think you're insulated in America or Canada or somewhere else if this is starting to spread all around? Remember, these markets are interlinked. We're all nodes in this thing. So if you're positioned in precious metals and you're just waiting for this, like this guy is, and a lot of other people, then isn't that kind of where you want to be? You want to be moving where the other people are moving to? Now, if you could get a 20% haircut, I look at it and say, all right, I'll just buy more. I don't care. Doesn't matter. It doesn't affect my life. A 20% haircut on my portfolio does not impact me in any way. And all I'm going to do is buy more. I'm just going to cost average in because why? That is the strategy. That is what I'm doing. Now, some of these guys are going to try to time all this in the short term. Very difficult to time. Very difficult to time, and I can tell you this, they're probably going to blow it. Why do I think they're going to blow it? Well, premiums, I don't really see the physical metals drawing down that much. The premiums seem like they move up and down based off of the price of the physical, or based off the price of the paper metals. The paper price could go to zero, the physical price could go to infinity, and the whole market breaks. Why is that? Because people will figure out that the paper markets are not worth anything. Then you look at, my energy holdings. I think that energy is the root cause of the problem. Why? Because everywhere I look where there's an energy problem, they have currency problems, bond crises, they've got riots, they've got declining stock markets, they've got increasing energy costs, all in those sectors. They're starting to shut down industry. It's gonna get pretty rough here, guys. What's the cause of this? Is the cause interest rates? You think interest rates are going to solve that in Germany? You think interest rates are going to solve it in the UK? Do you think if they went in there and they're gonna raise interest rates, that they're gonna solve anything? I don't think so. I don't think so. Now in America, we're, and Canada and some of these other countries, they're blessed with energy. And we are extracting some of these energy. But I don't know if these banks are totally insulated from other banks going down in terms of the bond markets and currencies and all these other markets that are having a lot of stress. Now, I didn't hear too many people say that we were going to have an energy crisis be the driver of a currency crisis. Everyone thinks that this is going to be some deflationary blowout. What if they're wrong? So what do we want to look at? We want to look at if they're wrong and if they're right, and what are the benefits and what's the positives and negatives about being right and wrong. So I'm positioned heavily in energy, and I'm positioned heavily in precious metals. Precious metals do very well in a crash type scenario. I guarantee my gold, probably even my silver and my platinum will outperform stocks in a deflationary type crash. Okay, so I'm basically in a spot where I want to be. Now, silver, maybe not, but it depends how much this hyperinflated bubble in stocks crashes. Energy, probably not a good spot to be in a deflationary type crash. But my question is, are we in a deflationary type crash? Are bonds in the UK falling because of deflation? No. What about Germany? No. Their consumer price indexes are going through the roof from an energy crisis. What makes you think that we are going to have a deflationary crisis in America then? if everywhere around us is having inflationary energy crisis problems? Makes me think that we're probably going to be in an inflationary crisis problem at some point in the United States, potentially. Maybe not, maybe so. So in a deflationary type crash, I get cut in half. I live another day, I still work, no big deal. But right then and there, I see my account value go down and I say, okay, I got to buy more. Now, did my account value go down further than where I purchased? Probably not. I'd still be up. And even if you were down, doesn't matter. Your life won't change. Products will be cheap. Things will be cheaper around you as long as you have a job and you're working. Now, if the energy crisis comes to us, if this is a global energy crisis, well, how would you want to position for that? And what are the downsides and negatives for that? Well, if you're positioning for a deflationary type crash and you went into bonds and dollars, you are going to get crushed if you're wrong. You are going to get absolutely crushed. Because what's going to happen? If people are running to gold and you're the last country in the world where people are going to run to you last, let's say the dollar's resilient. Let's say the dollar milkshake theory is correct. All the other currencies get slaughtered before the United States. We're sitting here fat, dumb, and happy going, hey, look, our dollar's awesome. It's really, really strong. It's killing it. But what happens when you're last? Well, silver's run out, gold's run out, platinum's run out. Everything's bought by all the other countries. They already ran and had their crisis first. It's kind of like losing your job last in a big layoff. All the other jobs are taken. You almost want to be the weakest worker where you get laid off first and you can find a job somewhere else real quick. But if you're the last one standing and everybody else found jobs and there's no openings left, well, that's kind of what happens. So if you're pinned into dollars and bonds are eating it right now, but if you've got dollars and your dollar's tanking, what are you going to run into? Everything else is going to moonshot in that type of scenario. Energy rockets higher, moonshots higher, precious metals, the physical metals are gone. What are you going to run to? You're going to chase? Just to preserve your purchasing power? Now you're like everyone else. Or you're sitting and buying this stuff, cost averaging in on the weaknesses and holding on. Now, I'm not saying that this is advice or anything like that. This is just my opinion, guys. This is my strategy, what I'm doing, how I'm positioning, and my viewpoints around it. What do I think can solve this crisis? I'm playing 15 moves ahead of I am playing 15 moves ahead of everyone else. Everyone else is looking at their portfolio, watching it go up and down. I'm looking at the big picture. What's the big picture? I'm flying 50,000 foot view, looking at everything. I'm looking at the war. I'm saying, oh, they're going to move here. They're going to play this next move. What's the next move here? If we have commodity shortages coming in a couple of years out, if we have an energy crisis, do you think we can go on an epic boom in commodities where we mine all of these different commodities in an epic fashion? I don't think so. Energy is going to be short. Well, if we can't do a mining boom, that means renewables are off the table and electric vehicles are off the table. They're gone. Well, what's left? King nuclear comes, blows everybody out of the water because what? It produces more energy on return on energy invested and produces the most amount of energy per mineral intensity. There's my solution. I want uranium. I want some exposure to that area. I want what we need to get out of the ground in order to mine. Well, what's that going to be? Oil, natural gas, all of these fossil fuels that have been providing the workload for a industrial revolution. We're not to this new era yet. And currencies are going to get absolutely smoked in this type of environment. So I want exposure to energy and the solutions to the energy problem. and anything that can help, people in general. I'm part of the solution. As weird as that sounds, at least my thinking. So what people are trying to do is they're getting scared. Recession, whatever. This is going to be the worst recession ever. Probably will be. What's the driver of it? What is the root cause? Now, it doesn't mean that just because energy is the driver, that you're going to be immune to a pullback in energy, because demand will have to be destroyed. The energy does not exist. So something will have to be destroyed. Something doesn't get built. A company goes bankrupt. Something has to go bust. That is deflationary. But what's causing that problem? It's energy, in my opinion. So what is this going to look like? It's going to be volatile as heck. But I'm going to stay long the issue or the problem. Stay long the problem. Protect myself against currency problems. If I get cut because of deflationary type volatility or movement, so what? Doesn't matter. I can live another day. If those guys are wrong and we get a big move higher and something happens to your currency or your bond market, they lose big. I live for another day. I'm positioned for it. So I win in either scenario. They win once, they may win in the short term if that happens, but if they're wrong, they lose big. They're not positioned right for the other move if they're 100% piled into one area. So, that's my take on it. I wanted to kind of share this. I don't think that raising interest rates is going to cause some of these types of crashes. I think it's going to be energy driven. The housing market has stopped its move going on up. It's slowed down. And let's take a look at it. I've got some slides here that we can look at. This is the 10. Let's just go in real quick. This is the 10-year yield breaking higher. A big picture view of it. We've got the new shift to increasing interest rates here. And that's the bond market selling off. If we had a deflationary type move, why are bonds rocketing higher? This is a debt crisis. And a debt crisis is going to need a bunch of money printed. We've got lumber here too. Lumber has been breaking higher out of its falling wedge. Well, why are we breaking higher in a deflationary type crash? Because it's not deflationary. That's why. We've got months of supply of houses, and this is 2019 right here, 2019, 2020, and we are still down. If this is 2021 and this is 2020, and 2020 is here, at the lowest it's ever been, we are still lower in terms of our inventory than basically all of history. And to me, where's the inventory? This isn't going up even. If this is 2019, that's still lower than basically all of what I've got on this chart here in terms of inventory. Where is this crash? If we're going to have a crash, we need to see these inventories rocket higher. Why aren't they rocketing higher? Because we don't have the homes. There's an imbalance in the market. It's being slowed down by the crisis and interest rates going up. The debt crisis. People are unloading bonds as quickly as possible throughout the world. So these things will slow down. In an energy crisis, housing market could weaken substantially. Why? Because people, they're going to be shutting down industry. People are going to lose a bunch of jobs. It's true. But right now, it's holding together at this particular time. And here's the median listing price. This is what they consider to be a crash. We've had our month over month come on down. We're at 13.9% year over year over the green line. But wait a minute. We have seasonality here in 2021 where this also declined roughly in the same area. Maybe not as much, but it still declined. It declined in 2019, 2018, and it declined in 2017 over this same period. Is this just a little bit more than the rest? It could be. No one knows if this is the beginning of the crash. We don't have inventory to for surely say that this is a crash that's ensuing. These guys are all premature worriers. We need to see the data change, and we need to see this, the next year, come right up on this line and hug it, showing us a slowdown or a cross in those lines where we actually have declining home prices. I don't think that's going to be possible till about May of next year. That's my guess, where we actually get a decline of a year-over-year number. So that's what I've got here, guys. I mean, if you guys need help working through this crisis, definitely subscribe to the Platinum membership on the finding-value.com. You can see it over there. And you can see the companies that I own. We've got CEOs coming out. They're saying, you guys don't have the copper. The mines don't exist. In a couple of years from now, we're going to see a big shortage of copper. We're going to see shortages of all these materials. CEOs are telling you straight up, we're going to see shortages. Does that sound deflationary to you or inflationary? I don't know. I'm just asking questions. So I'm positioning for the inflationary move because if I'm wrong, yes, I lose some money in my account, but I live for another day and I get to buy more cheaper shares. If the deflationists are wrong and we see big inflation, when are they going to jump on the train? I don't know. I'm already on the train. I started in 2020 and I've been riding the inflationary wave. So that's what I've got for today, guys. Hopefully you enjoyed the clip. Give me a thumbs up if you like the content. Subscribe to the channel if you haven't already. And we'll catch you again. This is Finding Value.